we're going to take a look at analyzing transactions, part 1. A business entity is an individual, association, or organization that engages in economic activities, financial activities, and controls specific economic resources. The business entity's finances need to be kept separate from those of the owner. So we just learned how the owner and the business, if it's a sole proprietor, are one unit legally. But as far as accounting is concerned, we need to keep the accounting of the business separate from the accounting of the owner. In other words, if the owner has purchased some groceries, then that is an expense of the owner, and we don't want to include it in the accounting transactions of the business. We're only interested in the activities of the business. We want to gather, process, and communicate financial information about a business to interested users. So we have to just rope off the business transactions. We have to look from the eyes of the business. Let's take a look at some different kinds of accounts that a business might have. First are assets. These are items owned by the business. That's a key word for assets, own. The business owns these things, and they will provide future benefits. They can't be rented. Something has to be owned. However, you can finance it. So if you buy a piece of equipment from a vendor and you owe them payments on it, so even though that equipment isn't fully paid off yet, that you own that equipment and you owe out on it, that's still okay. You include that as an asset. But if you don't own and are never going to own, you're just renting it, that piece of equipment, then you would not include it in the business assets. The business does not own that. Here's some examples of assets. First is cash. When we say cash in terms of accounting and business, we mean the checking account, not a roll of cash bills and coins. Merchandise is inventory. If we are a merchandiser and we sell products, then we would have those products. We would buy the products from the manufacturer and we would put them out on our shelves to sell, and we own that merchandise inventory. We might own some furniture and fixtures in the store. We might, the business might purchase and own some machinery and equipment of various kinds, including things like computers. The business might own some buildings and some land. There's also an asset called accounts receivable. This is where the customers owe us money. Whenever we sell something to a customer on account or on credit, that means the customer is going to pay us later. So we're letting them walk out the door with the item, but they're not going to pay us until later. And so this is not the same as them using a credit card. The credit card, we're going to get the money right away, and they will owe the money to the credit card company or to the bank. But here, we're making an account, a sale on account directly with them. So now they're going to owe us. Now, if we make a sale today on account, then right now today we are not receiving any money, but we will receive in the future. Okay? Right now today we do own that money. It just happens to be in the customer's pocket, and we'll receive the money in the future. But right now today we still legally own that money. If they never give it to us, we can take them to court. Legally, we own that money, so it is an asset. The business owns that money. They just don't have it in their hand yet. Liabilities means that we're going to have to pay something out in the future. In other words, today, we owe out to others. So if we purchase something on account, then we're going to walk out the door with that piece of equipment, but we're going to owe payments out to a vendor or suppliers. And whenever we owe out, that's the key word for liabilities. Whenever we owe out, that's going to be a liability type of account. And here's some examples of liabilities. Accounts payable means we owe out to a vendor. Notes payable means we've signed a promissory note and we owe out typically to a bank. With accounts payable, this is an unwritten promise, a verbal promise, in other words, to pay that supplier for whatever assets we purchased or whatever services that we received from them. We're just giving them a verbal promise that we are going to pay them back on it. And that is legal in a court of law, that we would have to pay them back if we bought that stuff on account. Now here's where we're going to talk about accounts receivable and accounts payable. When we talked about accounts receivable, we said that we're going to receive it in the future. This is today, customers owe us. We're going to receive it in the future. So that's accounts receivable. It's an asset because right now, today, we legally own that money even though it's not in our hand. Accounts payable means we're going to pay it in the future, and right now, today, we owe it out to somebody else. It's a liability. With notes payable, we have a formal written promise to pay the suppliers or the lenders, the bank, or whatever. Whatever is left over, if we take all the assets and add it up and subtract out whatever we owe out to the creditors, then whatever is left over for the owner. This is also called net worth or capital. Here's an example. If a business has a total assets of $100,000 and total liabilities of $60,000, what is the owner's equity? Once all the $60,000 of debts are paid, the remaining assets belong to the owners. And that would be $40,000. Now, we can take that, what we just did, and rearrange it, and just have the assets on the left side, and put the liabilities over on the right side, and we would have assets equals liabilities plus owner's equity. This is the most common way that accountants put the equation. Again, the equation can be rephrased in different ways and still be equal, but this is the way accountants like it. Assets equals liabilities plus owner's equity. That way the assets, the things that the company owns, is on the left side, and those who have a right to claim the assets, the creditors, which is the liabilities, and the owners, which is the owner's equity, is on the right side. Okay, again, getting back to the business entity concept, the owner may have business assets and liabilities and personal assets and liabilities. We need to keep those separate. We need to make sure that we're looking from the eyes of the business, pretending like we're just the business. What is the business receiving and what is the business giving up? The owner invests money in the business. The business now owns that cash. The business received the cash, and the business now owns the cash, and that is now an asset of the business. Here again is the accounting equation. The left side has the assets, the things we own. The right side shows where the money came from and who has claims against those assets. Okay, the money came from creditors, or the money came from the owners, and those two groups both have the ability to come and take the assets away. What is a business transaction? This is an economic, a financial event that has a direct impact of the business. It requires something given up to be equal to something received. Accounting started back in the 1200s when I give you a lamb and you give me X number of bags of corn or wheat, okay? And we negotiate and we settle on exactly how many bags of corn and wheat you need to give me in exchange for this lamb. Okay? And to this day, that's a business transaction. If something being given up if there's just something being given up and there's nothing being received, then it is not a business transaction. If we call Office Max and order some accounting pads, that is not a business transaction. We have not received the accounting pads yet. Now, once they send us the accounting pads, now that's a business transaction because we've received the accounting pads and we're giving up the fact that we have to pay for them. We have to be able to measure the exchange in dollars, and all of these transactions affect the accounting equation through specific accounts. And we talked about all the different kinds of assets, liabilities, accounts, and these accounts would be all listed in that company's chart of accounts. So an account is a separate record used to summarize the changes in each asset, liability, and owner's equity of a business. So I'm going to have a separate account page for the cash, i.e. the checking account, a separate account page for the merchandise inventory, a separate account for the equipment, etc. To analyze a business transaction, once I've looked at the transaction and I determine, yes, we're giving up something, we're receiving something, this is a business transaction, then I have to ask myself 3 questions. Question number 1, what happened? We want to put this in plain, simple English. We want to say, what are we giving up and what are we receiving? Okay? You want to just dig into that and make sure you understand the underlying core of what is taking place. What are we giving up, i.e. the business? What is the business giving up? What is the business receiving? Question number 2, which accounts are affected? Here's where you need to go to the chart of accounts. You cannot make up account names. You have to use the accounts that are in the chart of accounts for that particular company. In some of our earlier homework assignments, they won't give you a chart of accounts. So if you want, you can use the chart, any chart of accounts that's in the book, and just use that as a stand-in. But in real life, and in most of our homework problems, you will be given a chart of accounts, and you can only use that. You can't make up accounts. So here we're going to look in that chart of accounts. We're going to look at look back at question 1, what did the business give up, and we're going to find an account that matches that. We're going to look back in question 1 and say, what did the business receive? And now we're going to look in the chart of accounts and find an account that matches that one. And then we're going to have to say, well, what kind of accounts are these? So is it an asset, a liabilities, or an owner's equity? Question number 3. How is the accounting equation affected? And we have 2 parts to this question. The first part is to determine which accounts have increased and which accounts have decreased. And if you go back up to the first question and look at the thing we're giving up and saying, do we have more or less of this? Look at the thing we're receiving and say, do we have more or less of this? And then put your plus and minus down on question 2 next to the accounting. The second part of question 3, we have to make sure that once we're all done, that the accounting equation remains in balance. The A equals L plus E. So let's take a look at some examples. And this is Mary Adams Consulting. Okay, so Mary, the owner, she invested $25,000 in the business. Okay, so here's our chart of accounts. For the assets, we have cash, accounts receivable, office supplies and equipment. There's our liabilities, accounts payable, and our owner's equity. And you can put the owner's name in just initials like that, Mary Adams, M.A., comma, capital, and M.A., comma, drawing. Capital is the account that we use if the owner is investing, is putting money or equipment into the business. An M.A. drawing is a withdrawals account. That's if the owner is taking money or equipment back out of the business. So there's our chart of accounts. Now we're going to go to question number 1. What happened? What did the business give up and what did the business receive? And we have to look from the eyes of the business. The business gave up a piece of itself and it received cash in exchange. Now, rather than try to understand the business giving up a piece of itself, which could be kind of confusing to understand, we're just going to not worry about it, and we're going to put the words owner investment for what it gave up, and for the receive, we'll use cash. The business is receiving the cash. The owner is giving up the cash, but the business is receiving the cash. We need to look from the eyes of the business. Pretend that we are the business. Are we giving up or receiving cash? We are receiving cash. Okay, now, we said that we're receiving cash, and now we have to, for question 2, we have to look at the chart of accounts and find an account that is for cash. Well, lo and behold, if we look at the chart of accounts, we see that there's an account called cash. It's an asset. So we're going to use that. Then we go back to question 1 and we see that the give up is called owner's investment. So we go back to the chart of accounts and we see owner's investment is when we use the capital account, M.A., comma, capital. So these are the 2 accounts that we're going to use. Cash for the receive and M.A. capital for the give up. Now we have to say what kind of accounts these are. Cash is an asset and M.A. capital is an owner's equity. Now we go to question 3. We determine if the accounts have increased or decreased. We go back up to the top where we said what happened. And we look under the receive and it says we received cash. We ask ourselves, does the business have more or less cash than it did 5 minutes ago? The business has more cash than it did 5 minutes ago. Then we look under the give up. Does the business have more or less owner investment than it did 5 minutes ago? 5 minutes ago there was no owner investment, and now there is. So there's more owner investment than there was. Don't get tripped up by the give up word. Okay, just ignore the receive and the give up word. Just look at the cash and say, do we have more or less of it? We have more of it. And then look at the owner investment words and say, do we have more or less of that? We have more of it. So our cash increased and MA capital also increased. The second part of question 3 says, does the accounting equation balance? So the cash increased by $25,000 and owner's equity increased by $25,000. So an increase of $25,000 equals an increase of $25,000. So it balances. Here's another example. Now the business itself purchased office supplies and they paid cash out of their own checking account. So here the business gave up cash and the business received some office supplies. Now for question 2, we have to say what accounts are we going to use. For the give up, we gave up cash. We're going to look in the chart of accounts, and yes, there is an account called cash. For office supplies on the receive part, we're going to look up on the account and we're going to see that there's an account called supplies. So we're going to use office supplies account and the cash account. Then we say, what kinds of accounts are these? Office supplies is an asset and cash is also an asset. Now we go to question 3. We go back up to the top and say, do we have more or less cash than we did 5 minutes ago? Okay, we spent it out, so we have less. And do we have more or less office supplies than we did 5 minutes ago? Well, 5 minutes ago we didn't have any office supplies, and now we do. So we have an increase in the office supplies and a decrease in the cash. Finally, we look and see if the accounting equation balances. So here we have minus a decrease of $800 in the cash, which is under assets. And we have an increase of $800 in the office supplies, which is also under the assets. Okay? The right-hand side of the equation is not affected at all. There's nothing there. So the right-hand side equals 0. Okay? The asset side has a minus 800 and a plus 800. So the asset side is 0, and the liability and owner equity side is also 0. So it is in balance. 0 equals 0. Let's look at another example. Here we the business purchased equipment on account. Remember, that means we're going to take the equipment home, but we're going to pay later on it. Okay, for $3,000. Question number 1. The business, what did it give up and what did it receive? The business gave up the fact that they owe out to a vendor. And they received a copy machine. Okay? Whenever you buy something on account, you now are putting this big, heavy obligation on your shoulders that you are going to give up. And so if you buy a car and you're going to make payments on it, you are now giving up the fact that you have that debt on your shoulders, that you know going forward that you're not going to be able to spend as much money on partying and having fun and going to movies, etc., because you have to pay on a car payment now. Okay? So You're giving up the fact that you're taking on this big obligation that you owe out to a vendor. Today, there was no cash exchange. So we're not getting up cash, we're not receiving cash. There's no cash involved in this transaction. Now, question number 2, we have to pick out the accounts. Well, we gave up the fact that we owe out to vendor, and if we look in the chart of accounts for owe out to vendor, that is accounts payable. And we received a copy machine, and we look under the chart of accounts. We now own the copy machine, so we know that's an asset. We look under the assets and we see that there's an office equipment account. So we're going to use that equipment account and the accounts payable accounts are the 2 accounts we're going to use. The equipment is an asset. Accounts payable is a liability. We owe out to the vendor. We go down to question 3. Question 3 tells us to go back up to the top and say, do we owe out more or less to the vendor than we did 5 minutes ago? Well, we owe more to the vendor. And do we have more or less office equipment than we did 5 minutes ago? Well, we now have more equipment than we did. So we have an increase in the equipment, and we have an increase in accounts payable. We owe out more to the vendor. Now we look and see if it balances. The equipment, which is an asset, has increased by $3,000, but the accounts payable account, we owe out $3,000 to a creditor, and so that has increased by $3,000 as well, and so it does balance. Here is where we're taking a look and seeing if everything in total balances. So here we have cash. We had $25,000. We subtracted $800. So there's $24,200 of cash. We have $800 of supplies and $3,000 of equipment. So in total, we have $28,000 of total assets. Okay, here we made a $400 payment on equipment. Okay, the business gave up cash, and now it owes out less to a vendor. So we're making a payment. So every time you make a payment on your car, you own a little bit more of the car, and a little bit is taken off of your shoulders. Your shoulders are a little bit lighter. You owe out less. Eventually, when you make that last payment, it's such a freedom and a happiness that there's nothing weighing you down now. Hopefully the car still runs at that time. Okay, so here the business is making a payment on that equipment. So they're giving up cash, they're sending cash to the vendor, and what it's receiving, it's not receiving any more equipment today. We already received the equipment in the past. These transactions, we're always asking, what did we give up today, and what did we receive today? Well, what we received today is the fact that we owe out less to the vendor. So for cash, we're going to look on the chart of accounts. We're going to use the account called cash. And when we owe out to a vendor, that's a liability. Anything owe out means a liability. We're going to look up accounts payable. Cash is an asset, and accounts payable is a liability. When we ask ourselves, is there more or less cash than there was 5 minutes ago? We paid it out, so we have less cash. Do we owe out more or less to the vendor? Well, we even said that we owe out less to the vendor, so we have a decrease in cash and a decrease in accounts payable. Does the transaction balance? We have $400 less in cash and $400 that we owe out to the vendor less as well. So we have a decrease of $400 equals a decrease of $400. It balances. Owner withdrawals. Okay, this is where the owner is taking or withdrawing cash or other assets from the business for their own personal use. Of course, you don't want to start a business and never get anything out of it. You start a business so that it will sell stuff and make money, and then you can take some of that money back out and spend it on your personal self. Okay, and we call this an owner withdrawal when that happens. So here's an example. Mary withdrew $1,500 for personal expenses. The business is giving up cash. Let's remember, we're looking from the eyes of the business. Mary personally is receiving cash. We don't care about Mary's side of the picture. The business, is the business receiving or giving up cash? The business is giving up cash. The business is paying cash out. Okay? But it's receiving the fact that Mary now has less claims on the asset. And just like an owner investment, rather than try to delve deep into that, we're just going to call it owner withdrawal. Now we go to question 2. The business was giving up cash, so we're going to use the account called cash. The business was under received, we had owner withdrawal. So we look on our chart of accounts, and that's going to be an owner's equity account. And we said that if it was an owner investment, we put it in the capital account. And if it's an owner withdrawal, we put it in the drawing account. So we're going to have MA comma drawing and cash are the two accounts we're going to use. MA drawing is an owner's equity account. Cash is an asset. Now we look at increase or decrease. We go back to the top. Does the business have more or less cash than it did 5 minutes ago? It has less cash. It paid it out. Does the business have more or less owner withdrawal than 5 minutes ago? Well, 5 minutes ago there was no owner withdrawal, and now we have an owner withdrawal. So we actually have more owner withdrawal than we did 5 minutes ago. Okay, so there's an increase in the owner withdrawal, and there's a decrease in the cash. Be careful. The drawing account will increase in this situation, but it will cause an overall decrease in owner's equity. We are reducing owner's equity even though we're increasing the withdrawal. The more withdrawals we make, the lower owner's equity is going to be. So we have a decrease in an asset called cash of $1,500. And we had an increase of drawing, but because it's going to then decrease owner's equity, we're going to change that increase to a decrease. And it balances.